Welcome to the Forex Trading Channel, where you learn to trade like institutional players. Today, we're going to break down one of the most powerful tools in professional trading, volume profile. Not just what it is, but how it actually works, how to use it in real trading, and most importantly, how to think like a professional when using it. If you truly understand volume profile, you will stop seeing the market as random candles and start seeing it as a structured auction driven by real money. Overview. In this video, we'll go step by step through everything you need to master volume profile. Here's exactly what we're going to cover. 1. Introduction. Why you must understand volume profile. 2. The true nature of the market, auction market. 3. What is volume profile? 4. Basic structure of volume profile. 4.1. Point of control, POC. 4.2. Value area, VAH and VAL. 4.3. High volume node, HVN. 4.4. Low volume node, LVN. 5. Core mindset, acceptance and rejection. 5.1. Acceptance. 5.2. Rejection. 5.3. The bigger meaning. 6. What does the profile shape tell you? 6.1. D-shape profile. 6.2. P-shape profile. 6.3. B-shape profile. 6.4. Double distribution. 7. Types of volume profile you need to know. 7.1. Session volume profile. 7.2. Fixed range volume profile. 7.3. Composite volume profile. 8. How to read volume profile in the correct sequence. 9. How to use volume profile in different market conditions. 9.1. Using volume profile in a sideways market. 9.2. Using volume profile in a trending market. 9.3. Using volume profile for breakouts. 10. Important practical setups. 10.1. Mean reversion to POC. 10.2. Rejection at VAH and VAL. 10.3. Break and acceptance outside value area. 10.4. LVN traverse. 10.5. HVN revisit. 11. Combining volume profile with order flow. 11.1. Profile plus CVD. 11.2. Profile plus footprint. 11.3. Profile plus bookmap, DOM. 11.4. Profile plus sweep. 12. Multi-timeframe context mapping. 14. Common mistakes when using volume profile. 15. Standard execution process before trading with volume profile. 16. Common real-world scenarios. 17. Risk management mindset when trading with volume profile. 18. Core conclusion. 1. Introduction. Why you must understand volume profile. Let's start with a simple truth. Most new traders look at the market in a very basic way. They ask questions like, is price going up or down? Are the candles strong or weak? What pattern is forming? Is the market trending or ranging? But here's the problem. That's only the surface of the market. Because what really matters is not just how price moves, but where the market actually trades. You need to understand at which price levels the market traded the most, at which levels the market rejected trading, where big money actually participated, and where price moved quickly, but without real acceptance. And this is exactly why volume profile is so important. If candlesticks show you price behavior over time, then volume profile shows you the structure of trading by price. Let me say that again, because this is critical. A candlestick chart shows you how the market moved. Volume profile shows you where the market agreed to trade. That is a huge difference. A trader who doesn't understand volume profile sees the market as just a sequence of candles. But a trader who understands volume profile sees the market as a two-sided auction, where price is constantly moving to find liquidity and areas of acceptance. 2. The true nature of the market, auction market. Now, to truly understand volume profile, you must first understand the real nature of the market. Financial markets, whether it's futures, Forex, indices, or crypto, all operate based on auction logic. In simple terms, the market is a continuous bidding process. Price does not move randomly, and it definitely does not move just because. Price moves because the market is always doing two things: searching for liquidity and searching for agreement between buyers and sellers. When a price level is considered fair, the market will spend more time there, trade a large amount of volume there. But when a price level is considered unfair, the market will leave that area very quickly. And this is the foundation of volume profile. In simple terms, high trading activity means market acceptance. Low trading activity means market rejection. That's why volume profile is not just another indicator. It is the footprint of the auction process itself. 3. What is volume profile? So now the question is, what exactly is volume profile? Volume profile is a chart that shows you how much volume was traded at each price level over a specific period of time. And this is very different from traditional volume, because traditional volume, the bars below your chart, only tell you how much volume happened during a candle. But volume profile tells you something much more powerful. It tells you where that volume actually happened. Let's look at a simple example. Imagine price moves from 2,400 to 2,420 during a session. A normal chart will just show you the movement, but volume profile will tell you the real story behind that move. Maybe price 2,408 had very high trading activity. Price 2,412 had very low activity. Price 2,415 had extremely high volume, and price 2,419 was quickly traded through and rejected. Now suddenly, the market is no longer just movement. It becomes a map of where the market accepts value and where it rejects it, and that is where the real power of volume profile comes in. 4. Basic structure of volume profile. Now that you understand the foundation, let's break down the core structure of volume profile. Because if you don't understand these components, you won't be able to read the market correctly. 4.1. Point of control, POC. Let's start with the most important level, the point of control, or POC. POC is the price level with the highest traded volume within a given profile. In simple terms, this is where the market traded the most, buyers and sellers had the highest agreement, and price was considered closest to fair value. What does POC actually mean? POC is often a price magnet, a balance point. A level price tends to return to the center of gravity of the market. Common misunderstanding. This is where many traders get it wrong. They think POC is strong support or resistance. That is not always true. POC only tells you where the most volume occurred. Whether it acts as support or resistance depends on market context. Are we trending or ranging? How price returns to that level? What order flow looks like at that moment? And whether it's the first test or multiple retests. Correct way to think about POC. In a range market, POC acts as the center of balance. Price rotates around it. In a trending market, POC can become a high probability pullback zone if the market continues to accept higher or lower prices. After a breakout, the old POC may become irrelevant because the market is shifting to a new value area. 4.2. Value area, VAH and VAL. Next, we have the value area. This is the range that contains about 70% of total traded volume. Within this range, VAH, value area high, is the upper boundary. VAL, value area low, is the lower boundary. Simply put, this is the zone where the market considers price to be fair. What does the value area tell you? If price is inside the value area, the market is balanced. Price tends to move back and forth. Behavior is rotational, not trending. But if price moves outside the value area, the market may be searching for a new value. There is potential for expansion, or it could be a false breakout. Deeper insight. This is very important. VAH and VAL are not just lines on your chart. They represent the boundaries of acceptance. So when price breaks out, don't ask, did price break out? Instead ask, is the market accepting prices outside this value area? That is the real question professionals ask. 4.3. High Volume Node, HVN. Now let's talk about high volume nodes, HVN. These are areas where the profile looks thick and bulging, meaning a lot of trading happened there. The market spent time there. There was strong participation and high acceptance. Role of HVN. HVN often acts as a balance zone, a support or resistance area based on volume. A level price tends to return to, a zone where price can get stuck. In real trading, HVN is often where institutions build positions, large orders get absorbed, buyers and sellers fight intensely. Correct understanding. But here's the key. HVN does not guarantee a reversal. It simply tells you this is an area where the market previously accepted price. The reaction depends on the context when price returns, the strength of momentum, whether there is absorption or exhaustion, whether aggressive volume fails to move price. 4.4. Low volume node, LVN. Now on the opposite side, we have low volume nodes, LVN. These are areas where the profile is thin, meaning the market did not spend time there. There was little trading activity. There was no real acceptance, and price moved through very quickly. What does LVN mean? LVN is often a rejected area, a liquidity void, a zone where price moves fast, a potential acceleration zone. In simple terms, HVN is where the market stays. LVN is where the market passes through. Practical usage. When price enters an LVN, if there is strong momentum, then price can move very fast. If there is no acceptance, then price won't stay there long. When price revisits an LVN, it usually behaves like a transition zone, not a place for consolidation. Common mistake. Many traders treat LVN like strong support or resistance. That is a mistake. LVN is not a wall. It is more like a high-speed corridor. 5. Core mindset, acceptance, and rejection. Now we arrive at the most important part of volume profile. If you don't understand this, everything else becomes mechanical and incomplete. Because at its core, volume profile is built on just two ideas: acceptance, rejection. 5.1. Acceptance. A price level is considered accepted when the market is comfortable trading there. You'll typically see large volume built at that level, the market spending a lot of time there, price rotating back and forth multiple times, and the market treating it as a temporary fair value. How to recognize acceptance. Acceptance is very visual. You'll notice the profile starts to bulge out. Volume is heavily concentrated. Price stays in that area for a long time, and it is not immediately pushed away. What acceptance really means. When the market accepts a price level, it means buyers and sellers are both willing to trade there. There is a relative balance, and the market sees no urgency to move away. In simple terms, this price is fair, for now. 5.2. Rejection. Now let's talk about the opposite, rejection. A price level is rejected when the market refuses to trade there. You'll see price move into an area and then quickly leave. Very little volume is built. The market doesn't stay, and the test of that level fails. How to recognize rejection. Rejection has very clear signs. The profile looks thin. Price moves quickly through the area. You see sharp sweeps and strong pullbacks. Large delta appears, but price fails to continue. You may even see absorption or trapped traders. What rejection really means. When the market rejects a price level, it means the price is not considered reasonable. There isn't enough liquidity to sustain trading, or a larger player is actively pushing price away. In simple terms, this price is not fair. 5.3. The bigger meaning. This is where the mindset shifts. Beginner traders ask, did price break out? Was support broken? Did resistance hold? But professional traders ask something very different. Is price being accepted or rejected here? Is this breakout real or just a probe? Is the market building a new value or just sweeping liquidity? This is a higher level of thinking, and this is what separates amateurs from professionals. 6. What does the profile shape tell you? Now let's go deeper. Volume profile is not just levels. It also has shape, and that shape tells you the behavior of the market. 6.1. D-shape profile. The D-shape appears when the market is balanced. You'll notice a rounded, full-profile POC sitting near the center. price rotating inside the value area. What it means: this is a classic two-sided auction. Buyers and sellers are in balance. This environment is ideal for mean reversion strategies, buying low and selling high within the range. But be careful. Breakouts from this structure require confirmation. Do not chase. 6.2 P-shape profile. The P-shape often forms after a strong upward move, especially when shorts are forced to cover. You'll see, the upper part of the profile is thick, the lower part is thin. What it means: there is strong buying pressure. Price has been pushed higher. Shorts are getting squeezed. But here's the key question: is the market building a new value at higher prices? Or is this just a temporary short squeeze? You must always confirm. 6.3 B-shape profile. The B-shape is the opposite of the P-shape. It often appears after a strong move down. You'll notice, the lower part is thick, the upper part is thin. What it means: this usually signals forced selling, long liquidation, panic exits. Now the market is trading more at lower prices, but again, you must ask, is this a new lower value forming, or just a temporary sell-off? 6.4 Double distribution. This is one of the most important structures. A double distribution profile shows two distinct volume clusters, separated by a thin, low-volume area. What it means: the market has accepted trading at two different price zones. The area in between is usually an LVN, a transition zone. And here's the key behavior: if price moves from one cluster to the other, it can move very quickly through that thin zone. When does this happen? You'll often see this structure during trend expansion days, strong repricing moves, shifts from one value area to another. Now you understand something powerful. Volume profile is not just about levels. It's about behavior. It's about structure. It's about how the market thinks. And in the next section, we're going to bring everything together and show you how to read volume profile in the correct sequence like a professional trader. 7. Types of volume profile you need to know. Now that you understand structure and mindset, let's talk about the different types of volume profile, because each type serves a different purpose, and knowing when to use which one is key. 7.1 Session volume profile. First, we have the session volume profile. This is the profile built for each individual trading session. What is it used for? Session profile is best for intraday analysis, identifying daily POC, VAH and VAL, understanding whether the current session is balanced or trending, and combining with tools like VWAP, DOM, Bookmap, and CVD. Key insight: if you are an intraday trader, this is not optional. You must know where today's value is forming, where price is accepted, and where it is being rejected. 7.2 Fixed range volume profile. Next, we have the fixed range volume profile. This allows you to manually select any portion of the chart and analyze volume within that specific move. What is it used for? Fixed range is ideal for measuring a specific price move, analyzing a consolidation range, breaking down a swing leg, understanding how volume is distributed inside a structure. Key advantage: unlike session profiles, you are not limited by time. You can measure exactly what you want: a breakout, a pullback, a full trend leg. This gives you much more flexibility. 7.3 Composite volume profile. Now, let's zoom out. The composite volume profile combines multiple sessions, days, or even weeks. What is it used for? Composite profile helps you identify major value areas, find key HVN and LVN levels, understand higher time frame structure, and see where current price sits in the bigger picture. Professional insight. Skilled traders never look at one time frame in isolation. They always know where today's price sits within the bigger structure. Are we at the top of value, the bottom, or right in the middle? That context changes everything. 8. How to read volume profile in the correct sequence. Now this is critical, because most traders look at volume profile, but they don't have a process, and without a process, you will make mistakes. Here is the framework I recommend. Step 1. Identify the market regime. Start with the big question: is the market trending or ranging? Is it balanced or imbalanced? Is it expanding into a new area or returning to balance? Why this matters? Because context changes everything. In a range market, you focus on rotation. You look for mean reversion. In a trend market, you focus on continuation. You look for acceptance in new areas. The same level, even the same POC, can behave completely differently depending on the regime. Step 2. Identify price location. Next, you must know exactly where price is. Ask yourself, is price inside or outside the value area? Is it near or far from the POC? Is it at an HVN or an LVN? Is it testing old value or building new value? Key principle: location is more important than signal. For example, a buy near VAL in a balanced market is completely different from a buy just below VAH after a failed breakout. Same action, different context, different outcome. Step 3. Observe the reaction. Now we move to the most important part: reaction. Don't just look at levels. Watch how price behaves around them. What to look for. When price reaches a level, ask, does it break VAH and hold or fail? Does it bounce from HVN weakly or strongly? When entering an LVN, does price accelerate? When crossing POC, is there acceptance on the other side? Critical insight. Volume profile is not a touch and enter tool. You don't trade because price hits a level. You trade based on how the market reacts to that level. Step 4. Think in scenarios, not entries. This is where professionals separate themselves. You don't think in entries. You think in if-then scenarios. Examples. If price breaks above VAH but fails and returns into value, you look for short back to POC. If price breaks VAH, builds volume above and holds on retest, you look for continuation long. If price moves from HVN into LVN with strong delta support, you expect a fast move to the next HVN. Final mindset. You are not predicting the market. You are reacting to what the market is doing, with structure, with logic, with context. 9. How to use volume profile in different market conditions. Now we move into something extremely important, because volume profile is not just about levels. It's about adapting to market conditions. The same level can behave completely differently depending on whether the market is ranging or trending. 9.1. Using volume profile in a sideways market. This is where volume profile works extremely well. Core logic. When the market is balanced, POC acts like a price magnet. VAH and VAL define the boundaries of value, and price tends to rotate from one side to the other. How to use it. Near VAL, look for long opportunities, but only if you see rejection. Near VAH, look for short opportunities, again, only with confirmation. Near POC, the middle of value, avoid FOMO because your risk to reward is poor. Important reminder, it's not as simple as touch VAL, go long, touch VAH, go short. That is beginner thinking. You must also look for liquidity sweeps, exhaustion, absorption, large delta without price follow-through, clear rejection behavior, and whether the market is preparing to break out. 9.2. Using volume profile in a trending market. Now let's talk about trends. This is where many traders make a big mistake. They keep trying to fade the POC in a strong trending market. Correct logic in a trend. When the market is trending, price can continuously build value higher or lower. Old POC can lose its importance. Previous value areas can be left behind. What you should focus on. Ask yourself, is the market accepting new prices? Are pullbacks being rejected? Is value shifting or staying the same? Value migration, key concept. This is one of the most powerful ideas. If over multiple sessions, POC is moving higher, value area is shifting higher, new HVNs are forming higher, that means money is accepting higher prices. That is bullish behavior. On the flip side, if everything is shifting lower, that is bearish migration. How to trade it. Don't try to pick tops or bottoms. Instead, wait for pullbacks into key profile zones. If the pullback is absorbed and holds, look for continuation. If price breaks below VAL and holds, favor continuation short. 9.3. Using volume profile for breakouts. Now let's talk about breakouts. This is where most traders fail, because they cannot distinguish between a real breakout, a fake breakout, a stop run, and true acceptance. The most important question, after a breakout, don't ask, did price break out? Instead ask, is the market accepting prices outside the value area? Signs of a true breakout. Price moves outside value. It does not get pulled back immediately. Volume builds outside. Retests hold. Order flow supports the move. A new volume cluster starts forming. Signs of a false breakout. Price breaks VAH or VAL, then quickly returns. No real volume builds outside. It's just a liquidity sweep. Delta spikes, but price fails. Price returns back into value fast. Key insight. In many cases, the best trade is actually the opposite direction after a failed breakout. 10. Important practical setups. Now we turn theory into execution. These are real setups you can apply in the market. 10.1. Mean reversion to POC. When to use. Market is balanced. Profile is D-shaped. No strong catalyst. Price is stretched away from POC. Logic. In balance, price tends to return to fair value, and POC represents that center. Execution. Wait for price near VAH or VAL. Look for rejection. Enter. Targeting a move back to POC. Place your stop beyond the rejection zone. Common mistakes. Using this in a strong trend. Fading continuously during expansion. Entering without confirmation. 10.2. Rejection at VAH, VAL. Logic. VAH and VAL define value boundaries. If the market fails to break out, price often rotates back inside. Typical scenario. Price moves to VAH, sweeps slightly above, fails to hold. Selling pressure appears. Price returns into value. Short back to POC, or deeper to VAL. Stronger confirmation. Clear liquidity sweep. Trapped breakout traders. CVD divergence. Absorption on footprint. 10.3. Break and acceptance outside value. Logic. When the market wants a new value area, it doesn't just break, it stays there. What to look for? Break above VAH. Price holds. Volume builds above. Retest holds. Buyers stay in control. This is a high-quality continuation setup. Targets. Next. HVN and LVN extensions. Higher value areas on the composite profile. 10.4. LVN traverse. Logic. When price enters a low volume area, if there is no resistance, price moves fast. How to use. Identify LVN between two HVNs. Wait for momentum into the zone. If order flow supports it, then follow the move. Target. The next HVN. Key reminder. LVN is not an entry signal. It is a zone of acceleration. 10.5. HVN revisit. Logic. When price returns to an HVN, the market is testing a previous area of acceptance. Two possible outcomes. Accepted again leads to price rotates. Rejected leads to continuation or reversal. What you must evaluate. Is this the first test or the fifth? Is momentum strong or weak? Is there absorption? What does the higher time frame support? 11. Combining volume profile with order flow. Now we move to the next level. This is where everything starts to come together. This is the upgrade from reading the map to timing the entry. Volume profile gives you the context. Order flow gives you the confirmation. If you only use volume profile, you know where the important zones are, but you don't know when to act. If you only use order flow, you see signals, but you don't know where they sit in the bigger structure. The real edge comes from combining both. 11.1. Profile plus CVD. Let's start with CVD, cumulative volume delta. CVD shows you how the aggressive side is behaving. Example, price moves up to VAH. CVD is rising strongly, but price fails to move higher and then pulls back. What does that mean? Aggressive buyers are being absorbed. This is a high probability failed breakout. Now the opposite. Price breaks above VAH. CVD rises strongly. Price holds above. Retest is shallow. That is a much higher probability true breakout. 11.2. Profile plus footprint. Next, we combine volume profile with footprint charts. Footprint shows executed volume at bid and ask, so you can see who is actually hitting the market. Example, at VAL. Sellers hit aggressively, but price does not move lower. Then suddenly, a buy imbalance appears, and price pushes up. This tells you sellers are exhausted, buyers are absorbing. This creates a strong, long reversal setup. 11.3. Profile plus bookmap, DOM. Now we go deeper into liquidity behavior. Bookmap and DOM show you where liquidity is sitting, whether large orders are real or fake, if icebergs are present, if a stop run is happening. Example, price moves up to VAH. You see heavy sell liquidity above. Buyers hit aggressively, but price cannot break through. Liquidity holds. Price reverses. That means VAH is being defended, and now the short setup becomes much higher quality. 11.4. Profile plus sweep. This is one of the most powerful combinations. Example, price sweeps above VAH breakout. Traders get trapped, but no value is built above. Price quickly returns back into value. This is not a breakout. This is a failed auction. Key insight. A failed auction often leads to a strong move in the opposite direction. 12. Multi-timeframe context mapping. Now let's zoom out again. One of the biggest mistakes traders make is focusing on just one small profile. The correct approach. You must combine higher timeframe context with lower timeframe execution. Higher timeframe. Here's what you identify. Composite, POC, major, HVN and LVN levels. Multi-day value areas. Key zones of acceptance, the edges of the larger structure. Lower time frame. Now you use the session profile to time your trades. Ask, where does today's open sit relative to the bigger value? Are we at the top, bottom, or middle? Are we rotating or breaking out? Example, mindset. Scenario 1. Price opens outside a multi-day value area, fails to hold, returns back inside. High probability of a failed breakout. Expect rotation. Scenario 2. Price opens outside value, holds outside, builds volume there. This is a true repricing move. 13. Questions you must ask yourself. Before entering any trade, you must ask yourself these questions. Is the market balanced or imbalanced? Is price inside or outside value? Am I near POC, VAH, VAL, HVN, or LVN? Is the market accepting or rejecting this level? Is this mean reversion or continuation? Do I have order flow confirmation? If I'm wrong, where is my invalidation? What is the next logical target? Final rule. If you cannot answer these questions, but you still enter a trade, you are trading based on emotion, not logic. 14. Common mistakes when using volume profile. Let's talk about what not to do, because avoiding mistakes is just as important as finding setups. Mistake 1. Treating POC as a magic line. POC is just the highest volume level. It does not mean price will automatically react there. Mistake 2. Ignoring market condition. A strategy that works in a range can fail badly in a trend. Context is everything. Mistake 3. Misunderstanding breakouts. Just because price breaks VAH doesn't mean it's a valid breakout. Without acceptance, it's often a trap. Mistake 4. Using volume profile mechanically. If your logic is touch VAH short, touch VAL long, you will lose. That's an oversimplified approach. Mistake 5. Ignoring the bigger picture. An intraday setup may look perfect, but if it's inside a higher time frame HVN, you might be trading in the wrong direction. Mistake 6. Not using confirmation. Volume profile gives you zones, not certainty. To improve your accuracy, you need confirmation from price action, delta, CVD, footprint, DOM/bookmap, sweep behavior. 15. Standard execution process before trading with volume profile. Now let's bring everything together into a practical execution framework. Because having knowledge is not enough. You need a process. Stage 1. Pre-market preparation. Before the market even opens, you should already know your map. Mark the composite POC. Identify major HVN and LVN levels. Mark the previous session's VAH and VAL, and assess where price sits within the larger structure. Key mindset. You are not entering the market blindly. You are preparing your battlefield in advance. Stage 2. Observe the open. Now the market opens, and this is where information starts to flow. Ask yourself, does price open inside or outside value? Is there a gap? Does price return to the previous value area? Do you see initiative buyers or sellers? Why this matters. The open often gives you the first clue about the intent of the session. Stage 3. Identify the type of day. Now classify the environment. Is this a balance day, trend day, neutral day, failed breakout day, double distribution day? Key insight. If you misread the day type, you will apply the wrong strategy, even if your levels are correct. Stage 4. Match your setups to the day type. Now you adapt. On a balance day, fade the edges. Look for mean reversion. On a trend day, focus on continuation. Look for pullbacks into acceptance. On a failed breakout day, trade back toward value. On a double distribution day, trade movement between volume clusters. Professional thinking. You don't force trades, you align your strategy with the environment. Stage 5. Timing with order flow. Now comes the entry, and this is where order flow becomes critical. Look for confirmation like sweeps, absorption, exhaustion, delta failure, iceberg orders, retest holds or rejection. Final rule. Volume profile gives you where. Order flow tells you when. 16. Common real-world scenarios. Now let's translate this into real situations. Scenario A. Price opens inside value. This usually leads to rotation first. Mindset. POC acts like a magnet. VAH and VAL define the battlefield. Avoid chasing breakouts early, unless there is clear acceptance. Prefer fading moves, especially if momentum is weak. Scenario B. Price opens above VAH. This is one of the most important situations. There are two outcomes. Outcome 1, holds above, bullish continuation. Outcome 2, fails and returns, failed breakout, short-term bearish. Key insight. The reaction matters more than the breakout itself. Scenario C, HVN to LVN move. When price moves from an HVN into an LVN, if momentum aligns, price can accelerate quickly toward the next HVN. Best use. This is ideal for momentum trading. Scenario D, LVN failure. Price reaches an LVN, but fails to move through. What it means. There is a strong opposing force. Be careful with continuation trades. The market may rotate back to the previous volume cluster. 17. Risk management mindset. Now let's talk about survival, because without risk management, nothing else matters. Using volume profile for stops. Volume profile helps you place logical stops, not random ones. Examples. Shorting a failed breakout above VAH. Stop goes above the failed acceptance zone. Long at VAL after rejection. Stop goes below the rejection or sweep low. Targets should follow structure. From edge to POC. From POC to opposite edge. From LVN to next HVN. From failed breakout to back into value. Key advantage. Your trades now have structure, not guesswork, not emotion. 18. Core conclusion. Let's bring everything together. If you had to summarize volume profile in a few key ideas, what volume profile really is. Volume profile is not a signal indicator. It does not tell you when to buy or sell. Instead, it helps you understand where the market accepts price, where it rejects price, what levels represent fair value, which areas are just transitions, when to expect rotation, when to expect expansion. The deeper insight. Volume profile changes how you see the market. You stop seeing random candles and start seeing a logical auction process. What it gives you. A map of volume distribution by price, helping you identify fair value, balance zones, imbalance areas, key transition points, the real power. The power of volume profile is not in POC, VAH, or VAL alone. It lies in how you read the relationship between price location, market context, and order flow reaction. Final edge. When you combine volume profile with order flow, CVD, footprint, DOM, bookmap, you are no longer guessing. You are reading market intent and building high-quality trading scenarios. If you want to trade like professionals, you must stop reacting to candles and start understanding the structure behind price. Volume profile is not just a tool, it is a way of thinking. If you found this video helpful, hit the like button, subscribe to the channel, and turn on notifications for more order flow analysis.